share my screen with one that's kind of really relevant and pertinent, I think, to any business at any stage, but particularly businesses that are on kind of some of the earlier journeys. Because kind of going back to my point of bank financing, sometimes businesses will be frustrated with their bank is if they're in the earlier stages of being a business owner because sometimes you're just out of policy because you don't have 2 years filed accounts, so the bank won't look at you from a credit position. One thing that a lot of alternative finance lenders will look at is selective invoice finance. So what this is where you have a debtor in place and the lender is looking at who that debtor is. So let's take an example of a kind of a food and beverage business. They are selling into Tesco, Morrison's, Asda, and Sainsbury's. They let's say they sell 50,000 into Tesco, 50,000 into Morrison's, 50,000 into Sainsbury's, and they are on payment terms that are quite challenging for the business in that they're delighted with these big customers that are buying their goods and services from them, but they're on 90-day payment terms, which means they have to go and get their goods shipped and sent into Tesco or Asda and Morrison's, but they're not getting the full payment for a 90-day cycle. So the reason why something like selective invoice finance is interesting to that business, they might be a young business, 12 months old, and they can't get a core bank to kind of give them initial credit. What they can do is with that existing invoice finance facility that's due to be paid, or two of them, they might say, okay, we're going to wait for our 50,000 Asda and our 50,000 Morrisons to pay us. But what I'm going to do is I'm going to advance my Tesco one now so I can get that £50,000 advanced up front, or say 90% of that advanced up front. So they have that working capital to invest in further stock of further food production that allows them to go out and win more businesses. So that's something that can be super relevant. The next one is a revolving credit facility. So it's very like an overdraft. And I think one of the reasons why it's really interesting for business owners is a lot of business owners are super familiar with overdrafts because it's probably one of the most commonly used forms of financing from a historic perspective. But after the global financial crisis, a lot of the core banks moved away from having and giving overdrafts because for every overdraft that they hold or are willing to give to the business, they have to count that, even if the overdraft isn't being used, as a percentage of their lending that they're allowed to give out relative to the size of their balance sheet. So if they have a load of overdrafts out there and they're not being used, they're not being able to max out on their kind of lending ability. So what you saw was a huge amount of banks move away from this overdraft facility. So enter the alternative finance market, which have set up similar type systems like revolving credit facilities. So what this allows the business owner is to have the surety peace of mind that they've got access to this sum of capital they can access at any given time. And the way it works is they get it set up so they know they have access to that facility, and then they use it at a period when they need to use it, and then they only pay when they use it. And then as soon as they repay it, that credit facility tops back up to what it was before. So again, it's very like that overdraft, but instead of having a constant ongoing kind of fee with it, it usually has a fee only when you use it. So again, it's something that offers lots of business flexibility at a time of the year when they may need it, because it might be a seasonal business that kind of needs to dip into it maybe after that Christmas period. Revenue-based financing. This I suppose the kind of the preempt to revenue-based finance was merchant-based finance. Works the exact same. So very popular with the retail, hospitality, logistics, e-commerce type businesses where they have a lot of working capital or cash flow going through things like Shopify if it's online, or WorldPay, Dojo terminals. And so what the revenue-based finance, the merchant finance provider is doing is analyzing all of the trends of what are the transactions coming through and what's the average number of monthly transactions going through. So you'll have scenarios now where you'll have e-commerce businesses thinking long and hard about their big window in the year, which is often around that Black Friday, Thanksgiving, Christmas sales period. But in order to say max out on that period, they probably need to be teed up for success. That means getting as much stock as possible now so that you know you can max out on that period. So what those types of businesses might do is look at a revenue-based finance facility. And what a revenue-based finance lender will start to do is analyze that average transaction. And what it will do is look at the average number of monthly recurring revenue that you're receiving as a business and look to elect to advance you with some of that. So it could be one times, two times, three times that average monthly recurring revenue. And then how you pay that is pay that back in future sales. So it's giving you that level of flexibility. So if you have a relatively quiet sales month, it's only taking a percentage of that smaller month. And then in the bigger months, it's taking obviously a large amount, same percentage. So it allows you to kind of flex over those periods where sales are lumpy. So often we see those kind of retail, hospitality, or e-commerce businesses during the summer months building up for their busy period using these types of facilities.